The most important thing, part 1. Before winning in the market, you have to change your thinking. It is 11 o'clock at night. An ordinary man is looking at stock prices on his phone. Until morning, that same stock was the winner of the future, but now it is submerged in red color. The question is not just about losing money, the question is, why did he buy it? He had not read any balance sheet. Just a friend had said, "Brother, this stock will run." On YouTube, a thumbnail was shining, "This opportunity will not come again." And in that very excitement, he had pressed the buy button. The next day the market opened, the price went down, and his confidence also started breaking along with it. Now he was thinking, is the stock market really gambling, or was the mistake somewhere in my thinking? Right from here begins Howard Marks's story. Because for him, the real game of investing starts before choosing a stock. The real question is not which share to buy, but how you will think differently from the rest of the people. From the outside, the stock market looks very simple. Open an app, search for a company, press the green button, and become an investor. But if it were that easy, why would stories of losses be so common? Today, the market in India is more accessible than ever before. In NSE data, investor accounts crossed the milestone of 24 crore by 2025, and retail participation grew very rapidly. However, amidst this shine, there is a dark side as well. Reuters, citing a SEBI study, reported that in 2025, net losses of retail individual traders in equity derivatives reached 1 trillion rupees. Think about it. On one side, crores of new people are entering the market. On the other side, lakhs of people are losing money due to speed, tips, and overconfidence. So is the problem in the market or in the way of looking at the market? Howard Marks says an uncomfortable thing right at this spot. In investing, an easy answer is often a dangerous answer. The thing that is looking obvious to everyone, that very thing many times proves to be the most expensive. Marks is the co-founder of Oaktree Capital Management. Oaktree's official profile shows that since the firm was formed in 1995, he has been closely connected with investment philosophy and big-picture decisions. However, his biggest identity is not just managing money. His identity is slowing down thinking. When the market screams, he asks, is what is visible really the whole truth? His book, The Most Important Thing, is not a shortcut manual. According to Columbia University Press, the book explains the keys to successful investment and the pitfalls that can destroy capital. Here is a twist. The name of the book is The Most Important Thing, but Marks does not call just one thing the most important. He explains that in investing, many things are important at the same time. This is just like when building a house, someone asks, what is most important? Brick, cement, or foundation? The answer is not simple. Because if one thing goes missing, the entire wall can become weak. The same thing happens in investing too. Knowledge is needed, patience is needed, discipline is needed, understanding of risk is needed, and most importantly, the courage to doubt one's own thinking is needed. Many people think about returns as soon as they enter the stock market. How much will be made? When will it be made? Which stock will double? But Mark's first question is the opposite. Do you know what you are doing? This question sounds basic, but this is the most dangerous spot. Because in the market, the maximum loss often happens to those people who feel that they have understood everything. The first mistake is taking investing to be simple. The second mistake is considering others smart and following them blindly. The third mistake is considering one's luck as skill. A stock went up, and the new investor felt that the strategy was working. But it could be that it was just the market's mood. It could be that it was just timing. It could be that it was just the crowd's excitement. Then that same investor puts big money in the next time. Now confidence is higher, research is lower, and risk stops being visible. The story turns right from here. Howard Marks says that a good investor should not just be right. He should be right in a different and better way than the rest of the people. Because in the market, reward goes not to consensus but to superior thinking. Right here comes the first big idea of the book, second-level thinking. This is not a fancy term. It means going below the surface and thinking where the ordinary investor stops. A first-level thinker says the company is good, buy the stock. A second-level thinker asks, the company is good, but has the price already become too expensive? A first-level thinker says, earnings came out bad, sell the stock. A second-level thinker asks, is the bad news temporary, and has the market dropped the price too much in fear? First-level thinking answers quickly. Second-level thinking increases questions before answering. And in the market, many times that very extra question can save lakhs of rupees. Suppose a famous company is showing continuous growth. Every influencer is praising it. Every second investor is saying this is a long-term winner. A first-level thinker will get excited. He will think everyone is buying, meaning the opportunity is big. But a second-level thinker will stop right there and ask, if everyone has already bought, where will the new buyer come from? This is the silent trap of the market. A good company is not always a good investment. If the price is too high and expectations are sky high, even a small disappointment can bring the stock down. On the other hand, there is a boring company. No one is talking about it. Its name does not appear in the news. Growth is slow. The chart is not exciting either. A first-level thinker will ignore it. However, a second-level thinker can see that the assets are strong, debt is manageable, and the price is so low that the market has considered the company almost dead. That is where a hidden opportunity might be concealed. This is the reason why Marx calls investing a game of the mind, not just a game of information. Today, information is on everyone's phone. But interpretation is still rare. Today, brokerage apps have made the market easy. KYC is digital, charts are colorful, orders are instant. But with increasing speed, wisdom does not come automatically. Earlier, people used to phone a broker. Now trading happens with a thumb. But human emotion is the same: fear, greed, FOMO, regret, and the comfort of walking with the crowd. This is the biggest move of the market. It forces you to take action. Every candle says do something. Every news alert says do not get late. However, in Howard Marks' philosophy, patience is not weakness. Patience is a weapon. Because the person who does not react to every noise is the one who is able to hear the real signal. The hardest job in investing is not buying a stock. The hardest job is accepting that perhaps your first thought could be wrong. This humility itself is the beginning of second-level thinking. Now look at another contradiction. Many people come into the market because they want to get rich quickly. But the desire to get rich quickly forces them to make wrong decisions quickly. They say just one big trade needs to go right. But Marx says, in investing, survival comes first, glory later. Because the one who remains in the game will keep learning. People often understand risk merely as a fall in price. But risk is deeper than this. Real risk is permanent loss, wrong assumptions, borrowed confidence, and that decision which you took without understanding. A stock fell 20%. It is not necessary that risk came true. If value is intact, then the fall can be an opportunity. But if the thesis itself was wrong, then price recovery becomes merely hope. Right here, the ordinary investor gets confused. He considers volatility to be risk and ignores real risk. Because volatility is visible on the screen but wrong thinking stays hidden inside. Howard Marks repeatedly points out that the market can be efficient, but it is not completely perfect. If the market were always perfect, bargains would never be found at all. However, if the market were wrong all the time, investing would become very easy. The real difficulty is that the market is sometimes right, sometimes wrong, and the investor has to recognize the difference. Recognizing this difference is the core of second-level thinking. What is the crowd thinking? What is already included in the price? How high is expectation? And in which direction can surprise come? Take a simple example. If everyone feels that the company is fantastic, being fantastic is not enough. The company will have to perform even more fantastically than expected. Otherwise, the stock can fall. And if everyone feels that the company is bad, being bad is not enough either. If it turns out slightly less bad than expected, the stock can go up. This is the inverted psychology of the market. Hearing this, many people think, so should one always go opposite to the crowd? No, being contrarian is not a magic formula either. Just being different is not enough. Being different for the right reason is essential. If the crowd is running away from a fire, jumping into the fire just to look different is not wisdom. Second-level thinking does not mean rebellion, it means better judgment. Marx's book teaches this very subtle difference. He says the path to successful investing is very often uncomfortable. Because when you buy a real bargain, people around you are often considering you wrong. When the market is in panic, fear is sold on TV. When the market is in a bubble, dreams are sold on TV. At both times, the investor is tested. In panic, courage is needed. In a bubble, discipline is needed. And in both, the hardest thing is removing your emotion from the decision seat. This is the reason why investing is not just numbers. It is psychology, behavior, history, and the art of living with uncertainty. Howard Marks warns against people who sell certainty. People who say the market will definitely go from here often carry more confidence and less humility. The truth is that no one knows the future. A great investor does not predict the future, he weighs possibilities. He asks, if I'm wrong, how much loss will happen? This question might sound boring, but this is what saves wealth. Because in the market, before earning money, one has to learn to save money. A first-level thinker sees the upside. A second-level thinker sees the downside along with the upside. A first-level thinker says, how much can be made? A second-level thinker asks, how much can go wrong? Right from here, investing matures. Return alone is not the story. Return is always read along with risk. If someone earned 30%, the question is, how much risk did he take? Many times risky behavior gets rewarded and people consider it genius. But there is a huge difference between a lucky jump and a strong process. Only time exposes this difference. In a bull market, everyone looks smart. Rising prices hide mistakes. But when the cycle turns, then it becomes known who was an investor and who was merely a passenger. In Mark's thinking, cycles are very important, but in part 1 we have to understand the mindset before the cycle. Because even someone who understands the cycle can make a wrong decision if caught in crowd psychology. Today, social media has turned investing into entertainment. Every day a new stock, a new chart, a new target. The attention economy wants you not to sit quietly. However, compounding does not like noise. Good investing often feels boring because it does not have drama every day. And many people cannot handle this very boredom. They mistake action for progress. They consider more trades as hard work. They take more opinions as knowledge. But in the market, activity and wisdom are different things. Howard Marks's first big lesson is this: if your thinking level is like the rest of the people, expecting extraordinary results is dangerous. This does not mean that an ordinary investor cannot be successful. This means that even an ordinary investor will have to learn extraordinary discipline. You will not have a terminal like Wall Street. You will not have an analyst team. But you can have one advantage: you can refuse to hurry. You can refuse to trade on every rumor. You can avoid chasing in every rally. You can stop yourself from panic selling in every fall. This sounds small, but in the market, this very small restraint becomes very large. Because money is made many times not just by earning but by not losing it in the wrong place. Now let us go back to that man who looked at his portfolio in panic at night. He was thinking that the market cheated him. But the truth was perhaps more personal than this. The market had merely changed the price. The confidence inside him broke because there was no real reasoning behind his purchase. He was holding not a stock but a borrowed opinion. And this is the biggest problem with a borrowed opinion. When the price falls, you do not know whether to hold, sell or buy more. Because conviction was never yours in the first place. Second-level thinking does not let conviction turn into blind faith. It says first understand, then believe, yet still leave room for doubt. This balance is rare. Too much confidence becomes arrogance. Too much doubt becomes paralysis. A great investor walks on the thin line between these two. This is the real payoff of part 1. Winning in the stock market does not start with the secret stock. It starts from that moment when you stop trusting easy answers immediately. Howard Marks does not teach us what to always buy in the market. He teaches us how to keep thinking in the market, especially when the rest of the people have stopped thinking. However, this is just the beginning. Because after second-level thinking, the next question is even deeper. If everyone is getting information, how does the market price turn out wrong? Is the market really efficient, or are there cracks inside its efficiency as well? And if there are cracks, how can an ordinary investor recognize them? In part 2, the story will go right where price and value stand face to face. And then it will be known that a stock looking cheap is not always cheap, and a stock looking expensive is not always expensive.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.